The retail trading world is built on myths. We have told that drawing few lines and following the moon patterns will lead to financial freedom. I wasn't satisfied with trusting the process, so I put 11 most popular strategies to the ultimate test. A cold, hard Python backtest. The results were either a masterclass in profitability or a $200,000 of lesson on what not to do. Let's look at the numbers. Strategy 1. The Fibonacci retracement. First up, Fibonacci. Theory is that market breathes in ratios, specifically the 0.382 and 618 levels. We wait for a pullback, look for a rejection, and then we enter. Net profit minus $82,000 and win rate only 12%. And max drawdown was minus 886%. A total disaster. Relying on a single tool to predict human psychology in EURUSD lead to a 900% drawdown. The math simply doesn't support the hype. I rank it D tier, zero profitability and zero scalability. Retail traders use Fibonacci because it makes them feel like a scientist, but without a narrative or a liquidity reason to bounce. The lines are just a graffiti on the chart. It's trap for those who doesn't understand order flow. Strategy 2. Fair value gaps. Now we move into institution territory. Fair value gaps. This identifies as a gap where market moves too fast for the orders to be filled. We treat these gaps as a magnet for the price. Net profit was $56,000, win rate was 77%, profit factor was 3.9. This is the first time we see real institution footprints on the chart. The 77% win rate is staggering. I rank it S tier. Extreme profitability and extreme scalability. You are no longer guessing, you are following the displacement of the actual capital. This strategy is backbone of trading strategy. That's why I spend months coding this logic into my own private algorithms. When you have edge this sharp, you don't trade it manually. You automate it so you never miss a gap. Strategy 3. The Elliott wave theory. The Elliott wave suggests that market moves in 5-wave sequence. It's highly subjective and relies on specific rules, like wave 3 being the longest. Net profit was minus $117,000 and win rate was 0%. The data is brutal. In the backtest, Elliott wave failed to yield a single winning trade. It's a theory that looks beautiful in the hindsight but crumbles in the real world market. I rank it D tier, the definition of analysis paralysis. Complexity is an enemy of execution. If your strategy requires 50 different rules to master before you enter a trade, you have already lost. Markets are chaotic. Your edge should be simple. Strategy 4. Renko charts. Renko removes noise of the time and focuses purely on the price movement. Every 1% movement creates a new block. Green for up and the red for down. The net profit was $24,000 and the win rate was 43%. The win rate is lower than the FVG, but look at the max drawdown, it's only 6%. This is a masterclass in capital preservation. I rank it A tier. High predictability, low stress. Renko is for disciplined traders. It's not about catching every move, it's about catching the right move. I've integrated Renko logic into several of my automated systems because it's one of the few ways where you can filter out market's fake volatility. Strategy 5. The Harmonic patterns. Harmonics are advanced shapes which are based on exact Fibonacci ratios. The bad pattern, for instance, requires 0.886 retracement at point D. Net profit $230,000 in loss and win rate was 0%. A nearly $250,000 loss. The market doesn't care about the geometric shapes. It cares about liquidity. I rank it D tier. Avoid it at all costs. As we see the massive gap between D tier retail traps and S tier institutional logic, the question becomes, how do you actually execute this? Most traders fail because they can't sit in front of a screen for 12 hours waiting for a fair value gap. I realized early on that my emotions were my biggest liability. That's why I took logic from S and S tier strategies you are seeing today and turned them into automated systems. I don't draw boxes anymore, my code does. If you are tired of manual grind and want to use these exact algorithms I have refined through these backtests, you can access my library through the link in description. It's designed for those who want to trade with the precision of a machine. Strategy 6. Breakout patterns. Breakouts are bread and butter of the retail trading analysis. The idea is simple. Wait for the market to coil like a spring into a wedge or a triangle and enter when the pressure finally releases. Net profit minus $9,000 and win rate was 31%. The win rate of 31% sounds manageable until you hear the max drawdown, which is minus 117%. In modern markets, breakouts are just a liquidity grab to trap the retail traders before making the final big move in the opposite direction. I rank it C tier. Low predictability and high chances of fake outs. The problem with breakout is that everyone sees the same triangle. If everyone is placing their buy orders at the same line, that's exactly where the big players sell into you. It's a strategy that worked in the 90s, but today you're just providing exit liquidity. Strategy 7. Reversal patterns. Reversal focus on finding the end of the trend. We look for patterns like double top or head and shoulder to signal that the current market move is exhausted. Net profit was $1,000. Technically profitable, but with profit factor of just 1.4. Means you're barely breaking even after commission and the slippage. You are just working too hard for too little. I rank it B tier. Moderate profitability, but very low efficient. Trying to catch a falling knife or time a market top is an ego game. While this strategy stayed in the green, the emotional toll for a 64% drawdown for $1,000 is a bad business game. There are easier ways to make money. Strategy 8. Candlestick patterns. This is the most basic form of price action. Traders look for shape of a candle, a wick here, a big body there, and assume that they know where the next 50 pips are going. Net profit, as you expected, minus $22,000 with win rate of only 3%. A 3% win rate, let that sink in. Relying on candlestick patterns without a context is just a gambling with a deck against you. I rank it D tier. Zero predictability, avoid it. A hammer candle at a wrong level is just a signal that more traders are going to get trapped. Don't let a single candle tell you the whole story that the higher time frames are contradicting. This is an entry-level trap which most traders never escape. Strategy 9. The moon phase. Now we enter the esoteric. The lunar strategy assumes the human emotions and thus the market moves or cycles with the moon. New moon for buys and the full moons for sell. Net profit was minus $7,000 and max drawdown was 95%. Surprisingly, it performed better than the candlestick strategy. But that's a low bar. Losing 95% of your account just because the moon isn't right isn't a trading strategy. It's a tragedy. I rank it D tier. For entertainment purpose only. If you are looking at the sky or the moon for trade in the markets, you have already given up on the logic. Stick to the data. Astrology is not an edge. It's a distraction from real work of understanding liquidity. Strategy 10. Support and resistance. Foundation of all technical analysis. Buy at support, sell at resistance is the first thing every retail trader learns. Net profit $1,000 and max drawdown was 800%. Again, technically profitable in terms of net dollars, but the drawdown makes it untradeable. A 800% drawdown means your account would have been liquidated 10 times before you saw profits. I rank it C tier. High risk, low reward. Support and resistance only work until they don't, and when they fail violently. These levels are just retail poles for institutions to target. If you want to trade these, you will need a level of automation that will exit the moment this wall fails. Strategy 11. Heikin Ashi. Heikin Ashi isn't a strategy, it's a filter. It doesn't show the real market price. Backtesting shows that the entry lag, the time taken for a smooth candle to the catch up to the real price, often eats 50% of your potential profits. I rank it B tier. Great for psychology, poor for precision. Heikin Ashi is like trading with the sunglasses on. It's easy on the eyes, but you're missing on the details. Use it to stay in the trade, but never use it to find your entry. For that, you need a raw data. The data is clear. Most of the strategies you see on social media are mathematically designed to fail. Out of 11 strategies, only a handful like fair value gaps and Renko provided real repeatable edge. I didn't make this video to discourage you, I only made it to show you that why I stopped trading manually. The winners in this list aren't just good ideas, they are precise mathematical imbalances. I've taken the logic from the top tier strategies and built them into algorithms that I use every single day. We have seen fair value gaps win and harmonic patterns fail, but we are only halfway through. In part 2, we are testing more relevant strategies and with more shocking results. So subscribe to my channel and click the bell icon so that you are the first one to know when the part 2 comes. And if you want to stop guessing and start trading with the same precision I have run on this backtest, the link of my algorithmic site is below. Don't be the liquidity for someone else's strategy, be the one who owns the code. Thanks for watching and see you in the part 2.